Hello everyone. Welcome to the class on advanced contracts, tendering and public procurement. Today's class is about bank guarantees. What are the important aspects of bank guarantee? We deal with different aspects of bank guarantee, law, rules and regulations and guidelines. It's important to know that bank guarantee is a legal and financial instrument to have a stable trade, business and infrastructural activities for the robust economic growth. What is the legal framework of bank guarantee? Let us try to understand the different law applicable to the bank guarantees. First and foremost, Indian Contract Act of 1872 deals with the contract of guarantees generally and the bank guarantees as applicable in specific areas of law. Indian Constitution, particular to Article 299 and Article 300 with respect to government contracts and public procurement. The next is Banking Regulations Act. This act empowers the RBI and banking institutions to make rules and regulations for obtaining the bank guarantees for the smooth economic growth of the country. RBI Rules and Notifications. RBI is empowered by the Banking Regulations Act and therefore is the Central Bank of India which regulates the entire banking system in the country. General Financial Rules of 2017. It's important to know that all the government procurement and contracts follow the general financial rules, as rules are made for procuring bank guarantees in government contracts. CVC Guidelines. Central Vigilance Commission determines important guidelines to be followed regarding bank guarantees, as the government is accountable because of public procurement. CAG Guidelines. The public procurement is audited by the Office of Controller and Auditor General and therefore makes essential guidelines for governments to be accountable in matters of bank guarantee. We next move on to Indian Contract Act. What is a contract of guarantee? There are three objects in contract of guarantee. There are principal debtor, surety and creditor. And as such, the bank guarantee also has three important components. They are principal debtor, surety and creditor, and it's important to know that the banks always act as a surety in the matters of bank guarantees. So there are two types of bank guarantee. One is limited and one is continuing bank guarantee. What is a limited bank guarantee? A guarantee extends to a single transaction which has a limited period of time and a limited liability which is between the principal debtor and the creditor. A guarantee which limits the transaction to a certain amount or to certain duration of the transaction is a simple limited bank guarantee. And what is a continuing bank guarantee? A guarantee which extends to the series of transactions between the principal debtor and the creditor. The guarantee has several distinct transactions. For example, in a government contracts which involves high value infrastructural projects, the limited bank guarantee is the continuing bank guarantee is applicable. Let us look into what is exactly a bank guarantee. As the word says, bank guarantee is a promissory legal instrument. What is promissory? Promissory means the bank guarantees the lender that the debtors, the liabilities of the debtors are catered in a timely manner. In a bank guarantee, the bank offers to stand as the guarantor on behalf of the business customer in a financial transaction. Bank guarantees are very commonly used among business entities because they help businesses as creditors gets reassurance to the repayment of loan if the business is for various reasons unable to repay the loan. When a bank signs a bank guarantee, it promises to pay any amount according to what is prescribed in the terms of the contract. Another important types of guarantees are direct and indirect bank guarantees. Direct guarantees are in foreign or domestic business are usually directly beneficial to the beneficiaries. For example, a financial guarantee, the bank acts as a surety and guarantees the payment to the creditor which is to be given by the principal debtor. And what is an indirect guarantee? Which is often in an international trade, which is not directly given to the beneficiaries, but is given to a any government agency or any other financial institution. For example, the bank acts as a surety to a foreign bank in an international transaction. Another important classification of bank guarantee is financial guarantee or a performance guarantee. Now, what is a financial guarantee? Financial bank guarantees is a debt owed from the debtor to the creditor. The bank guarantees that the buyer will repay the debts owed to the seller. So when the buyer fails to do so, the bank shall repay the debt to the beneficiary. And what is a performance guarantee? The terms and conditions in a performance guarantee, the terms and conditions are specified in the contract. The contract is dependent on the execution of a performance as mentioned in the terms of the contract. The business entity, when unable to provide the services as promised, the beneficiary claim it from the guarantor, which is actually a bank. Now, there are various advantages of bank guarantees. As such, the bank guarantee reduces the financial risk involved in the business transaction. Because of the nature of low risk, beneficiaries are encouraged to expand their business on a credit basis. So banks generally charge some interest for guarantees, which is beneficial and affordable to small-scale businesses like MSMEs. Bank guarantees are also an important way to analyze and certify the financial stability of the business. The very reason that the bank guarantees are regulated by RBI and therefore due diligence is conducted by the banks and it increases the creditworthiness of the business houses. Bank guarantees to cover all the liabilities as prescribed in the contract. When the bank guarantee is exercised or invoked, the beneficiaries receive payment from the bank. The courts have time and again emphasized that timely bank guarantee payment of a bank guarantee when invoked is the right of a business house. The bank guarantee is advantageous to the long-term projects or a continuing guarantee. But let's also look into what are the challenges of a bank guarantee. For certain guarantees involving high value or high risk transactions, banks require collateral security to process the guarantee. And therefore, along with the security deposit, the banks require an additional collateral security to be maintained so that there is a low risk involved. The strict assessment of banks, the due diligence by the banks, sees that the creditworthiness of the business houses is increased, but sometimes the strict assessments take a long time. Financial guarantee is considered to assume more risk than a performance guarantee. Hence, the fee for financial guarantee is higher than the fee charged for the performance guarantee. A continuing guarantee extends to a series of transactions and therefore the banks require collateral as well as they charge high interest. This makes the working capital and certain amount of working capital to be deposited in the bank. Now, what are the sections applicable under the Indian Contract Act? Section 128, Section 133, Section 134 and Section 145. It's important to note that in a bank guarantee, since bank acts as a surety, all the rights and liabilities of the surety is attached to the bank. And therefore, all these sections are applicable to the banks as surety. In an important case by the Supreme Court of India, Maharashtra Electricity Board, Bombay Official Liquidator and the High Court of Ernakulam, the Supreme Court held that when a bank guarantee is invoked, the banks has to pay the amount, and in a categorical statement, the Supreme Court held that the bank guarantee is an independent and separate contract. The liability of the bank is not dependent on any underlying contract. What are the judicial observations? The Delhi High Court, in its several judicial interventions, has stated that banks must promptly honor the commitment of guarantees when invoked. In the words of the Delhi High Court, bank guarantee is a contract between the beneficiary and the bank. When the beneficiary invokes the bank guarantee and a letter invoking the same is sent to the bank, it's obligatory for the bank to make payment. In another important case, in UP Cooperative Federation Limited versus Singh Consultants, in the words of Supreme Court said that, we are therefore of the opinion that the correct position of law is that commitment of banks must be honored free from interference by the courts. And only exceptional cases where the court can intervene is the case of fraud. And because of these High Court and the Supreme Court interventions, the RBI has made certain rules for the payment of invoked guarantees. When guarantees are invoked, payment should be made to the beneficiaries without delay. An appropriate procedure for ensuring such immediate honoring of guarantees has to be laid down by every banking institutions in the contract. There shall be no delay on the pretext that a legal advice or an approval is required. Delays on the part of banks in honoring the guarantees when invoked tend to erode the value of bank guarantees. This RBI observation has led for the RBI to make specific rules for invoking bank guarantees and the payment. It also provides an opportunity to the parties to take recourse to courts and obtain injunctions, which is actually a legal entanglement. Let us look into what is an RBI Master Circular on guarantees. The Reserve Bank of India on 9th November 2021 consolidated all the instructions and guidelines issued to the banks till June 30, 2015. This circular is applicable to all web-scheduled commercial banks, and this circular is available in the RBI website. Now, it is a statutory directive issued by the RBI in the exercise of powers conferred by the Banking Regulation Act of 1949. Since, as a part of business, banks issues guarantees, it's important that the RBI regulate the conduct of business in case of bank guarantees. The General Financial Rules of 2017 is an important rule in the government procurement. There were two latest amendments regarding the bank guarantees. They are accepting of electronic bank guarantees, which is in tune with the Make in India and the IT development of the country, and the surety bonds are accepted in lieu of the bank guarantees. Let us look into what are surety bonds. From the Union Budget, since the Union Budget 22 and 23, in order to reduce the indirect cost. So what is an indirect cost? Indirect cost is around 20 to 30% of the working capital given to the banks as security deposit or as a collateral, makes the suppliers and the work contracts increase their cost, and therefore the government has come to a decision that to ease the liquidity, the surety bonds are accepted as substitute for bank guarantees. The important types of surety bonds are as same as bank guarantees. They are advance payment bond, bid bond, contract bond, performance bond, and retention money. So to make surety bond accept in lieu of bank guarantees, an amendment to General Financial Rules was made to ease the business transaction, and therefore the Insurance Regulatory and Development Authority of India made the guidelines, because the insurance sector has come into the financial market, which results in improved liquidity as bank guarantees require nearly 20% of the working capital. Since the involvement of the insurance company increases the private investments, and it also diversifies the risks as insurance bodies act as an alternative to banks. Revenue and capital market access is given to the insurance companies. As such, there is more credit flow and liquidity into the financial market. Now, it also has access to increased project opportunities, and therefore, because of high infrastructure projects having high value and high risks, insurance company acts as a surety. What are the essential features of surety insurance contract? The essential feature of a surety insurance contract is that insurance contract is essentially a contract of indemnity. But when it becomes a surety insurance contract, it becomes a contract of guarantee and shall be a contract of guarantee under Section 126 of the Indian Contract Act. It's a contract to perform the promise or discharge the liability of a third person in case of a default. The person who gives the guarantee is called the surety, and the person in respect of whose default the guarantee is given is called the principal debtor. The person to whom the guarantee is given is called the creditor. It's important to know that insurance, when is an indemnity contract, has two parties, and insurance, when it becomes a guarantee, it has three parties and a tripartite agreement. So what are the types of surety contracts? They are advance payment bond, bid bonds, contract bonds, customs and code bonds, performance bond, and retention money bonds. So now let us look into what is the difference between bank guarantee and surety bonds. Bank guarantees are accompanied by collaterals and the high amount of security deposits, whereas surety bonds are collateral free. Bank guarantee is a tripartite agreement, and as such, surety, when as an insurance, when is an indemnity, is a two-party agreement, but when the insurance becomes a surety contract, it becomes a three-party agreement. The bank guarantees are payable on demand, which means when invoked, the banks are obliged to pay the guarantee. And surety bonds are issued by the insurance company for the tenure of the project, and it is reimbursed like an insurance policy. Bank guarantees has to be renewed periodically, and the duration as determined by the RBI. RBI regulates the bank guarantees, whereas IRDA regulates the surety bonds. Let us also know what is letter of credit. A letter of credit is a contract wherein a bank guarantees the payment of a supplier. It has essential features of a bank guarantee. The supplier meets the conditions agreed upon in the letter of credit. In a letter of credit of a sales contract, the important entities are buyer, the issuing bank, and an advising bank. The feature of a letter of credit that it is an indirect bank guarantee. It is usually an international trade, and since it is applied in international trade, the banks should comply with the directions, regulations issued under the Foreign Exchange Management Regulations as amended from time to time. What is the validity of bank guarantee? Bank guarantees are issued as per the Indian Contract Act of 1872 and the Limitation Act of 1963. The statutory limitation period for invoking the bank guarantee is 3 years for individuals, 30 years for government contracts, and 12 months over and above the expiry date of bank guarantee. And 12 months over and above the expiry date of bank guarantee is called the grace period and is also recognized by the higher courts of India. The banks have the automatic extension and renewal clause in the contract. As per the RBI guidelines, the bank guarantee should normally have a maturity of up to 10 years, which can be renewed from time to time, as per the RBI regulations. Therefore, when the bank extends long-term guarantee, it has to look into the impact on the asset liability and management. We have seen that since post-COVID, the economy requires more liquidity, more infusion of capital in the market for infrastructure projects and the government projects or for the government procurement. As such, bank guarantees plays a vital role in the economic growth of the country, and also surety bonds and the letter of credit. That's about bank guarantee and its legal framework. I hope this video was educative to all the learners. Thank you.